US imports from China are absolutely plummeting. What looks like great news for the trade deficit could actually spell trouble for the stock market, housing prices, and the US bond market. Is this a hidden recession signal? We are getting government data again, massive implications for the dollar's reserve status, as well as the returns of the stock market, home prices, and of course, the US bond market. Let's go through this report. By the way, I will link the report in the description. Now, here we can see imports and exports on a monthly basis. Right now, imports about $340 billion per month and exports about $280 billion per month. Now, if we look at goods, just the goods side, we can see a very large goods deficit of about $300 billion for the year 2024 with China. If we go to the European Union, that is about $250 billion goods deficit for the year 2024. Now, the US does run a services surplus. So here we can see that services side, the surplus side, but it is nowhere near enough to make up for the very, very large goods deficit. Again, here with the EU, we can see about a $90 billion per year services surplus. But if we go to the EU for the goods deficit, we can see that it is far in excess of any surplus that we might run on the services side, about $250 billion for the year 2024. Here is the overall balance on goods and services. We can see very, very large deficit with China. This is obviously the main target of the trade war, which is really a capital war. We can also see that Mexico, we run a very, very large trade deficit overall, goods and services, with Mexico, as well as, of course, the European Union. Now, this is one of the notable findings from the report. I made a chart from the Excel spreadsheet of the BEA data. This is quarterly data, so each bar represents one quarter, 1 3-month period of time. We can see just from Q1, our goods deficit with China has decreased by almost 50%. So we can see it went from $80 billion per quarter for the first quarter to just about $40 billion per quarter. We can see just a massive decrease in terms of the goods deficit with China. Now, here, by the way, is trade by group, and here, by the way, are recessions. So we can see that imports generally plummet right ahead of an economic slowdown. Now, I will point out 2022, we did have a bear market in the stock market, and we also did have 2 consecutive quarters of negative GDP, generally thought of as the definition of a recession. FINRA agrees. I took the SIE or practice to take it, and that question is in there. What is the definition of a recession? 2 consecutive quarters of negative GDP was, of course, FINRA's version of the answer, but there was no technical recession back then. But in general, we can see the red shaded areas indicating recessions. We can see that imports, for example, ahead of .com, started to roll over ahead of the technical a call for the start of the recession. Now, 2008, it peaked during into the recession. So about a couple months into the recession, that was actually when imports started to roll over. By the way, I will show that going into 2020, it actually started to roll over. Imports started to roll over in 2019, long before all the events of 2020. Now, why does this matter? Balance of trade here, we can see $59 billion per month. This is overall goods and services. That works out to about $714 billion per year, or about 2% of GDP. Now, this is a major improvement from the kind of levels that we were at recently, where we were at 5% of GDP. And I will remind folks that The Economist put out a great article, and it's cited in Wikipedia's article as well, of the causes of the 2008 GFC, that the housing bubble in part was caused by the very large trade deficit. If you're not aware of how that works, don't worry. That's what we're getting into now. So this is the massive implications that balancing trade would have on the dollar's reserve status, as well as the stock market and of course, the bond market and US real estate prices. So here is a chart that shows with one scale, we can see the balance of trade on a quarterly basis and the current account on a quarterly basis. We can see they are basically the same thing. Now, there is a small gap between the trade deficit or the balance of trade, excuse me, and the current account. That is where primary and secondary income gets recorded. But as we can see, is a very, very minor component. The vast majority of the current account is the balance of trade. We can see the gap is very, very narrow for that primary and secondary income. By the way, that's where foreign remittances and foreign aid, that's where those get recorded. So here we're looking at the current account and the capital and financial account. So the mirror image of a large trade deficit. Now, again, we established over here that the balance of trade, our trade deficit, is basically the current account. We can see that here. So the other side of that current account deficit is a capital and financial account surplus. This is a very, very basic kind of international finance balance of payments sort of concept here. But if you run a very, very large trade deficit, right now we can see about $251 billion per quarter. Well, you have to come up with $251 billion per quarter somehow, because again, remember what that means. The US is sending $251 billion per 3-month period out to the rest of the world. Well, we have to come up with that somehow. Again, we run a trade deficit. So the value of our imports far exceeds the value of our income that we are making to selling to the rest of the world. So we have to come up with it somehow. Well, how do we come up with it? We come up with it by capital and financial account surplus, by capital inflows into things like the U.S. bond market, whether that be U.S. treasuries or corporate bonds, also U.S. equities, so the U.S. stock market, as well as real estate. Now, just for that real estate component, I actually went through all the BEA reports. If you total up the amount of foreign direct investment in real estate, which again is just a mechanical balancing sort of phenomenon to a very large trade deficit, the foreign purchases of real estate over the past 15 years work out to about 800,000 single family homes. So trade deficit has massive, massive implications, as we will see also for financial assets. Again, a very large trade deficit. That is how we get dollars out to the rest of the world. Triffin's dilemma is we run ever larger trade deficits because that is the way that we get dollars to the rest of the world. The rest of the world needs dollars. The way we get them those dollars is by sending them dollars for stuff. That is the curse of the global reserve currency status. That is Triffin's dilemma. Here, again, it's also important the capital and financial account surplus, massively underappreciated dynamic. Here, by the way, we will see the net worth of the top 1% as a share of GDP. So when the green line is going up, the net worth of the top 1% is growing faster than the overall economy is growing. And of course, you can see the correlation there with the capital and financial account surplus, and it makes sense intuitively. Who owns all the financial assets that those foreigners are purchasing? Remember, if we're running a $251 billion per quarter trade deficit, current account deficit, the other way of saying that is that 251, $250 billion is flowing into financial assets here in the US every 3 months. So if you annualize that out, that works out to $1 trillion per year. Now we run about a $2 trillion deficit. So just for comparison, the deficit could be funded by 50%. The capital inflows would fund about 50% of our very large fiscal deficit. That is the difference between what the government spends and what it collects in tax revenue. Well, who owns all the financial assets that are getting bid up by $251 billion of capital inflows per quarter? It is the net worth of the top 1%. So as the trade deficit gets worse, remember that this is the inverse. This is the mirror image of the current account, and the current account is basically the balance of trade. The larger the current account deficit, the balance of trade gets. The other way of saying that is the larger the capital and financial account surplus becomes, well, who benefits from the foreign bidding of financial assets? It is those that hold financial assets. So we can see a correlation. By the way, the net worth of the top 1% started to really outperform what the capital and financial account would indicate. That was when QE2 and then, of course, QE3 really kind of turbocharged it later. And by the way, here are corporate profits. We can see that they also massively benefit from a capital and financial account surplus. Remember, they get cheaper labor. A corporation can outsource their labor and get much cheaper labor in the developing, emerging market sort of economies. They can access cheaper labor, build things cheaper, and then sell them to, of course, the U.S. consumer. Now, it's important to point out, twin deficit country here in the U.S., by definition, the U.S. overconsumes. By nature of running a twin deficit on an aggregate basis, the U.S. overconsumes. Well, how do they overconsume? How can you overconsume? You go into debt. The only thing a twin deficit country can do, can accumulate, the only asset that a twin deficit country can accumulate is debt. You cannot accumulate assets like Japan. Now, if you saw the video yesterday, Japan is in the exact opposite sort of position. They have run a current account surplus, a trade surplus, meaning that they are running a capital and financial account deficit, meaning that dollars or yen are flowing, wealth is flowing out of the country in terms of the capital and financial account, again, because there's so much wealth flowing in, more than they consume, more than they buy from the rest of the world, that they are buying financial assets of the rest of the world, in large part the US. Well, we are in the exact opposite position, which is that we run very large trade deficits. The way we finance those trade deficits is by, of course, running a capital and financial account surplus. That massively benefits financial asset holders because right now, as of right now, $1 trillion mechanically on a balance of payments, just a pure accounting basis, $1 trillion must flow into US financial assets every single year. So we sell them NVIDIA at a 45 price to earnings. We sell them US Treasuries at a 4% on the 10-year, and they send us stuff. Now, by the way, this is part of the reason the dot-com bubble got blown, was that we were running a balanced fiscal budget. So there was no net increase of new debt. And so all that foreign capital had to flow into something dollar denominated. Well, it flowed into US tech stocks. And of course, the 2008 GFC, the housing bubble, in large part caused by a very, very large balance of trade deficit. So massive implications. If Trump is really serious about balancing trade, as it appears we're headed in that direction, two massive implications. Number one, that foreign capital inflow is going to stop. And what impact does that have on corporate profits, on the stock market, on the bond market? Remember, $1 trillion per year must flow into U.S. financial assets. Our fiscal deficit right now is about $2 trillion per year. Just for comparison, just for context, what does that mean for the U.S. bond market if foreign buyers mechanically start to step away? Because again, we are running a smaller trade deficit, number one. Number two, for the dollar's reserve status, if we do truly balance trade, that is basically saying the dollar's reserve status is over. We are done with Triffin's dilemma. We are exiting from Triffin's dilemma, and we are saying we are no longer the global reserve currency status. Remember, this is part of the reason the dollar has become so structurally overvalued, is that so much inelastic demand for dollars and dollar-denominated assets. And of course, that overvalued dollar just makes the trade deficit even worse. So anyways, hopefully that was helpful. I'll link the report in the description. I'll catch you in the next one.